Well, good afternoon, and thank you for attending this session. I think it's fair to say this morning we addressed two of the issues that really we need to look at. What is the mix of economic policies, monetary policies that we look at going forward? What are the goals of those policies? Again, inflation. And in answer to one of my questions, certainly policymakers feel that 2% inflation is realistic and that bank lending is helped by the LTROs. But now we're into the third question, which is the focus of the two sessions this afternoon. How effective can such policies be? And how do the real economies and the financial markets respond to that? So what we're going to look at in this session is a focus on some Southern European countries that oftentimes I feel don't get enough recognition in panels and conferences like this. So we're going to talk a little bit about these three countries, a little bit about their economics, and a little bit about where things are. And I think that's kind of important. So do we have any gentlemen willing to stand up first and speak, or shoot? So Manuel is going to speak first. And he is a latecomer to the agenda, but I certainly thank him for stepping up to the plate. Thank you, Manuel.
Okay. Thank you very much, John. Thank you to GIC and the Banque de France for organizing this conference, and it's a pleasure to be here. I mean, as John said, I'm the first speaker, and I was not in the agenda. At least I was not in the agenda in this panel. I was in the following panel. And, you know, being European, there's two ways to look at it, right? The first one is what we was mentioned before, and Catherine mentioned it, and I think she's completely right. You know, it's the problem is the flexibility of the of the European market, right? Why am I the speaker? Because there is a controller strike in France, and the person who was supposed to be here, Jorge Sicilia, couldn't make it, right? His plane was canceled, right? But I think there's another way of looking at it, and that's the way I tend to look at it, and we're flexible, right? So, yeah, when you find a rigidity, you get around it, right? So instead of just going belly up and say, okay, we'll cancel his presentation, whatever, we just adjust, right? So instead of having him talk, I will, right? And thing goes, and life goes on. Nothing happens, probably you'll wonder what he has to say, so even more interest for whatever he comes on what he has to say, which probably will be very different from what I have to say. So you can look at the glass either half empty or half full. So this flexibility, these problems, rigidities in Europe are a problem, definitely they are, but also this is nothing new. This is Europe. We've always been inflexible or rigid. So to the extent that we can get rid of some of these rigidities, in growth terms, it actually looks quite good. Level terms, we're in trouble, we're rigid, but in growth terms, we're erasing those rigidities. A structural reform, which I agree completely should be the first thing in the agenda, is the slow arrow that Weber mentioned. But to the extent that we're doing that, actually we don't look that bad. So I'm going to talk mainly about Spain and Europe. And the title I had was actually Running to Stand Still, right? For those of you, right, John, this is too young for you. This is some for you too, right? So it's probably after your time. Actually, if you remember the song, pretty much it was something like, there you are, lying still, and suddenly all the urgency comes on, and you do a lot of things. That's Europe, right? Nothing happens, and suddenly there's a crisis, something happens, and you just resort. And you move forward, and then when the pressure is lifted, we go back to sleep, right? And that's pretty much Europe. So I want to keep those two things in mind. The title of the talk was actually response to everything else. I have to admit, I think this chart pretty much is my whole thing. I'm actually much more optimistic on the world than what I heard this morning. It seems like everybody's quite pessimistic on growth. Given we're not going to grow fast, right? 2% in the US, okay, that's not great. It's 2%. It's 7 years in running 2%. It's not bad. Europe between 1.5 and around 1.5, maybe higher than that. Hey, that's not bad, right? So at least in the developed economies, we're growing. We're not in full speed. And yeah, emerging economies are having problems. But the ones that are having problems are actually commodity producers and whatever. China, 6-7% growth, even lower. Yeah, but that's the new norm. So that's okay. I don't think we should be that negative. And when you look to Europe, actually growth has been relatively consistent. And if we had any surprises, have actually been to higher in 2016, particularly in my own country, Spain. 2 years ago, or 3 years ago, people said, recession for the foreseeable future. Nobody saw a growth ever, pretty much. Unemployment rate, 25% or worse, right? And I have Portugal. I mean, Spain is going to look good because Portugal actually looked even worse at the time, and then they're doing quite well. So Europe has actually been able to do a lot of things. And growth now, last year, was close to 3%. And when you look at, for Spain, sorry, and when you look at Spain right now, it's around 2.5%. So for 2016, 2017, you have growth rates around 2.5% in Spain, which is not bad. And when you look at Europe as a whole, it's around 1.5%. If you look at the average, historical average, that's not bad. So saying that Europe is not growing, I don't think that's the case. But, I tend to, numbers are numbers, so I like to look at colors. Red is bad, green is good. That's Europe. If I go back farther, 2013, 2012, it was all red. Now it's all green. Right? These are short-term indicators. Doesn't matter which country I look at. Pretty much, there's a little orange at the end, but pretty much all the indicators are looking okay, right? Even the UK. The UK was the one who looked the best, actually, except for the external sector. So at least the existing conditions right now, the actual indicators right now, are not looking all that bad. So our worries are going down the line. And even when you compare to the US, this is an indicator we built. It's similar to the Fed CF9, which is like, actually this is a little wider. It has like 80, 90 indicators. In Europe, it's like 130 because of the variety. But it's just a signal extraction problem. When you realize, actually, yeah, Europe had problems in 2012. It's clearly there, right? But since then, actually, it's been growing. And it's growing above trend. It's true, our trend is low. And the whole problem in Europe is not growing at trend. It's how do we improve that trend. But at least in the short term, things don't look that bad. And let me tell you why. 4 reasons, and I'll concentrate. First, and these are the reasons I would use for almost any country in the world. Commodities, prices, China, emerging economies, monetary policy, and domestic risks. I will not get a lot in detail into dropping oil prices, but it's unambiguously a positive shock for the European economy. Doesn't matter how we look at it. In the US, you may have some questions because of Texas, production, and whatever. In Europe, it's an ambiguously positive shock. I know there's a lot of talk because of markets, something I didn't mention. Markets are crazy lately, but the real economy is actually doing much better than markets. Right? Remember that saying that financial markets have anticipated 5 of the last 9 recessions? Right? That's still the case. If you update that, it's actually 7 of the last 13. So the fact that markets are wiggly and nervous does not mean that the world is collapsing. And if anything, if I'm worried about anything, it's actually oil prices seem to be going up a little bit. I have no idea why people are happy about this, but it seems that make people happy. But the truth is that with oil prices remaining around $40, $50, it's actually quite positive for growth in the European economy. Right? So that's clearly green. How about China? I'm not going to go into China. I'm not an expert. 2 ideas, either pessimistic or optimistic. I will not get into that. In any case, everybody more or less agrees that it's not going to be a meltdown in China, only a slowdown, significant slowdown. But in any case, Europe is actually very little exposed to China. The country that's the most directly exposed is Germany, because it exports quite a bit to China, but we don't export commodities, which is the main channel through which China affects the world economy. And when you look at countries like Italy or Spain, actually, we have literally no exposure to China. So whatever happens in China really does not affect us very significantly. Maybe the channel is the financial markets, right? To what extent the financial markets, the appreciation of the euro, if that happens because of the depreciation of the yuan or whatever, that affects the economy. But it's the financial channel the one that matters here. It's not the direct channel or the trade channel. So China, in any case, I would say China is a red. How about monetary policy? Monetary policy is the diverging monetary policy we have worldwide. Obviously, U.S. eventually, we don't know when because they keep postponing these things every time I meet with them. It seems like it's going to be soon, right? And then you realize actually soon means next year, right? But eventually they will have to tighten rates faster than we had all anticipated, right? And eventually they will surprise us on the other side. But in any case, they're on the way up, but that's not the case in Europe. In Europe, if anything, we're continuing with a very loose monetary policy. It's going to continue to be that way. You heard it before this morning. Either negative rates, LTROs, or whatever else we can make up to actually drive the economy. And when you look at it, actually, the way that monetary policy works, traditional monetary policy worked mainly through the traditional channels. Mainly the lending channel, banking channel was the most traditional. QE worked through the wealth effect, primarily. And that's why, actually, that was affected in the US, the wealth effect, that's why it was so powerful in the US. In Europe, the wealth effect, the wealth channel is much less powerful because the wealth effect of actually assets, except non-residential assets in particular, it's much smaller on consumption and other things. So you have to use QE, straight QE a la American, wouldn't work or wouldn't have the same impact. So you try something else. Negative rates, LTROs. Negative rates have traditionally worked through the exchange rate channel. But that was the case in countries like Denmark, Sweden, right? I would even say even Switzerland, although to a less extent. There were markets that were small. The euro is a large market, so working through the exchange rate channel is actually very, very complicated. The way it's actually working is, back again, through the banking sector, to the extent that it's increasing credit, right? By pushing banks to lend and not to keep funds, right? Obviously, that's on the negative side of that is that it's exerting additional negative pressure on the banking sector, right? Banking sector, which we know in Europe hasn't restructured all the way, probably, and I have two bankers with me, so they'll probably rebate everything I say, right? But that has to continue changing, and probably we'll see consolidation. But to some extent, the LTROs that the ECB passed is a lifesaver for banks. At the same time, it's allowing them or forcing them or giving them a reason, an incentive to lend, it's actually giving them a way to finance themselves. So it's trying to play both cards. The alternative, do I like negative rates? No, probably not. I don't like all this stuff. I'm an orthodox kind of guy, but the alternative is sitting on the sidelines. And that's probably not alternative at all. Why? One of the countries that has the largest impact, the negative rates and the banking credit, has actually been Spain. One of the reasons why Spain has grown in the last year, yeah, we passed a lot of reform, and that's probably the key, passing reform 3 years ago. But since then, the latest impact has been banking credit. We even have mortgage credit coming. And that, in part, has to do because of the push by the ECB, the easy money, and these incentives for the banking sector to pass on credit. I don't have a graph here, but I think it was shown that this morning by Mr. Villeroy, by Governor Villeroy, which is the interest rates at which corporates are financing themselves, small corporates. Spain still has the highest rate among the largest countries. It has the highest rate, but it's the one that has come down the most, right? So in terms of growth, that's actually very positive. When people say, but that hasn't had a huge impact in Germany or France, you say, obviously, because rates actually have reduced much less than they have in Spain or Italy. So to that extent, the fact that the negative rates and monetary policy working through the banking sector, pressuring the banking sector, is putting, let's say, new risks into the system, banking, but it's aiding the real economy. Why is the ECB doing this, right? I said it's not growth. I showed growth is more or less okay. Perspective is not bad. But inflation is. First, ECB has an inflation target, and they haven't met it for a long time. And if you don't meet your target, you have to do something about it. They're doing anything they can. Right now, actually, there's no problem to the extent that this inflation, I don't like to call it deflation, because it's not leading to a drop in consumption. Therefore, we don't see this negative inflation, negative consumption spiral, right? We don't see it yet, but there's a risk. There are risks of the anchoring inflation expectations, and particularly, there's a negative interest a risk of distorting financial markets, the financial stability. I mean, so these are all risks. But the ECB has opted to do rather too much rather than too little, right? The second one, which I think is even more important, is actually debt deflation spiral. Remember 2012, right? If you have negative inflation, forget about the impact on consumption or whatever. What is true is that fiscal adjustment becomes more severe. You have more difficult to repay your debts. And that's what happened in 2012, and that led to the risk of default, right, by several countries, primarily, obviously, Greece was still there, but Spain, Portugal, a number of countries were there, were on the line, right? So you want to prevent this. You don't want it to get, and it affects the real economy as well, because the moment spreads shoot through the roof, the economy collapses, right? But not only that, that had led to a sudden stop risk, a credit crunch, that was the main risk, and breakup of the euro even. That's what people were talking about in 2012. How many people were projecting that the euro wouldn't exist now? Tons of them. Part of the reason was this debt deflation spiral. So one of the things that the ECB is doing is buying insurance. This cannot happen, right? And they're trying to make sure that we don't go down this road, right? Obviously, the countries who are the most benefited by this, I would say all of the countries in the periphery, particularly Spain, Spain and Italy probably, because they are large enough to matter a lot, right? So if Spain or Italy have a problem, then the rest of Europe has a problem. It's not like Greece, which you can buy your way out, right? And finally, domestic risks. And the first risk is, going back to my title thing, is this was integration, right? This was the whole thing, banking union, this is all we had to do. We don't talk about that anymore, right? This is the main risk. We went back to sleep, right? After 2012, we talked about integration, blah, 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 all the things we were doing. Not quite. I mean, banking union has moved forward. I mean, we've done things, but truly not to the extent that it was anticipated. Political economy dominates economic policy in Europe. And particularly, there's a dominance of domestic politics. And to that extent, integration has put back to sleep. That's the main risk. The other risks, mainly Brexit, I won't go into them, refugees. I'm very worried about the third one, political polarization, populism. There is a strong growth of populism and Euroscepticism that is going to make it quite hard to implement reform. But on the other hand, there's a question, and there's something to be talked about. I won't do it now. But why did this grow? And the reason why it grew, in part, it was because disenchantment with the policies taken and the winners and losers from the recession, right? Catalonia, I put it there, breakup, I doubt it. It's actually moving farther away. I would do it too bad because I'm a Barcelona fan, and that would mean I would have to pick a different team in Spain, but that's my main worry. But I don't think that will happen. I think that's a negotiating posture right now, and Europe would not allow it. Right? And the final one is Greece. Greece to the extent of back to 2012. Right? We haven't solved the Greek or the Spanish or whatever problems. We just kick them forward, right? And they will come back. I'm worried about the summer, right? We have Brexit, likely Spanish elections, likely Greece, all coming at the same time or around the same time. And markets are edgy, right? And that might be a bad time for everything. But in spite of all those risks, look at consumer and business confidence back in September of last year, right? Before a lot of these things were in the scenario. Look at it now. It seems that consumers and even businesses are not that worried. If anything, you see a big drop or relatively decent drop in the UK, right? Maybe Poland, but literally, I mean, they're all in green. So business and consumer confidence does not look as bad as all that pessimism that people are putting on the floor, on the ground. So 2 greens, 2 red. I think, I personally, half empty, half full. I personally think that the greens are brighter than the reds, so I tend to be overly optimistic. But remember, there are a lot of gray swans. I call them gray swans because are things that we know are there, but normally we don't have into our forecasts. And then there are probably black swans as well. So there are a lot of things that we haven't accounted for. They have economic reasons for happening, but, and they have economic consequences, but normally they're not into our forecast. And a lot of this might happen. None of these things, actually maybe this one was the only one, but the rest were not anticipated by economists, right? Nobody anticipated the drop in oil prices or Russia or anything else, and they did happen and they had an economic consequence. But in conclusion, I really do remain optimistic. I think that it's not as bad as markets are putting it forth. I think Europe looks better than it has in a long time. It's not great, but there's a lot of rooms for reform, but I think we have the time. And somebody mentioned today, Europe tends to react in time of crisis. So it's not bad that we are, on the edge of crisis for us to react. Thank you.
Well, CEMEX always has some amazing, colorful charts, clearly done by Gaudi and not El Greco, so I'll take the difference there. So yes, in fact, talking about flexibility in terms of our team that's getting here, we'll now turn to Jose, who could not get to Paris directly, but flew to Brussels, then took a train last night to get here. So indeed, we have a lot of flexibility on this team, but Jose?
Thank you, John. I see people, presenters today are a bit obsessed with the colors, the green and the red. And the Portuguese flag is half green, half red. So I don't know what it means, but maybe I can find out during my presentation. Okay. So I wanted to tell you a bit about the Portuguese economic history since the beginning of this century, and trying to find a suitable title. I came up with the other one. I think it really describes what happened. There was this big bust without any shred of a boom. Okay. So this quick summary, but it's divided in these three topics. And starting with the crisis build-up. You maybe thought it was a joke. The title was a joke. It isn't. If you look at real GDP growth on average from 2000 until 2010, you realize that it was way below 1% real GDP growth. Okay, I will speak a bit more about this, but okay. So, even though it's low levels, it was consumption, private and public, that overperformed, whereas investment had, for this 11-year period, average growth rate, which was negative. Okay. Now, at the same time, we had this huge build-up of debt in all sectors, being it households, non-financial corporations, and the government, okay? From 2000 to 2010, and from 2010 to 2014, okay? So we had in Portugal very low growth until the sovereign debt crisis struck. Once that happened, there was this big recession, okay? Basically everything went down, domestic demand, only exports held up or actually increased. And that built up sorry, why did it do this? Okay, because I pressed the button, right. And so this build up to the crisis was basically, or happened with a huge build up in terms of debt. Okay. So that Portugal was a ugly duckling is not difficult, and if we compare with Spain, which is the most obvious comparison, then the difference is very stark. Okay. Also, Spain did build a lot of debt, but not on the government sector. Whereas one feature of the Portuguese economic process during the first 10 years, first decade of the century was that debt was basically increasing in every sector by more or less the same kind of pace. Okay, so this is the change of debt between the beginning of the century and 2010. Okay, if one looks at Germany, which and this period comprises or includes that part of German history that made some analysts to call Germany the sick man of Europe, still the legacy of the reunification. But even though Portuguese underperformed Germany, and we know that Germany is not doing very well, unlike Portugal. And if you look at the growth change profile, then you will see that Portuguese economy was making something not very was making something bad in the first 10 years of the decade. Okay, the Portuguese economy only overperformed Italy's, but then I guess that's the only OECD country that grew less than Portugal. That was Italy, and even though that was the case, in terms of that build-up, the Portuguese economy accumulated more debt than did the Italian. Okay, so how did that happen? The thing is, it was not real estate mania like in, for sure, Ireland, also Spain, even Greece. So here we have house prices in Portugal, which is the red line here, or the dark pink, has gone nowhere in 10 years. Okay, if you compare with other countries that had a financial assistance package. The same conclusion you'll get if you look at gross value added in the construction sector. So there was no real estate mania. There was not a construction boom or bubble that led to first low growth and then the recession. So the question is, where did all the debt go? And it turns out it went to basically private and public consumption. It was not much because the economy was not producing a lot of income. Okay, but the thing is, as Professor Weber mentioned this morning, the problem with these economic cycles in which there's a consumption binge financed by debt is that you don't accumulate capital, so you're not producing the collateral from which you can milk the income to serve the very debt which funded this consumption binge in the first place. Okay, so you have this problem. You know you have a problem when you fund an economic cycle that is basically a cycle of increased consumption and decreasing investment, as we saw happen in Portugal, because then you don't have the means, you don't have the productive potential to pay back the debt you used to consume a lot, in relative terms, of course. Now, but I've already mentioned this, the idea that there was no convergence, even though the Portuguese average GDP per capita is lower than the Portuguese GDP per capita is lower than the average European average. There was no convergence at all, okay? Unlike, for example, Spain, which has been growing very steadily, or grew very steadily before the sovereign debt crisis. And if you look at the unemployment rate was increasing even during the good times, even though good times in Portugal for the first 10 years of the decade was a relative concept. Okay, so there was no convergence at all for the first 10 years of the decade, which coincide, of course, with the first 10 years of the euro, or 11 years of the euro. Okay, the usual culprits for a balance of payment crisis is basically there's loss of competitiveness. For example, here I showed the unit labor costs, the annual change of unit labor costs in Portugal, and compare it with one of the best practices in Europe, which is Germany, and you clearly see there's a clear loss of competitiveness of Portugal vis-à-vis the the euro area's average, and particularly against Germany. And that is compensated for with debt, okay? Because basically the Portuguese economy was not able to generate the goods and services that the Portuguese public needed and wanted, and so it basically imported it, and thereby generating debt vis-à-vis the rest of the world. Now, you know that when you have twin deficits of 10% each, you know that enough is enough. Okay? This was only possible because investors and pretty much everyone blurred the risks or couldn't discriminate risks across EMU countries. And so investors kept and banks kept financing, international banks kept financing the Portuguese economic model, which was obviously unsustainable. And even though fiscal balances were not as big as they became in 2010, they were persistently negative, so there was this persistent fiscal deficits. But the current account deficit, which is in this red line, the bars, they were huge. Okay, and when you get 10% of each of these balances, fiscal and external, this kind of deficits, then there's only one ending to this story, and that is a sudden stop that here I portray as this spike in government sovereign bond yields. Now everything basically that was tied to domestic demand decisions basically just plunged. Okay, we have here imports of goods and services. So the sovereign debt crisis was basically beginning of 2011. Okay, so we had this huge plunge in imports, construction as well, because it's one of the most sensitive sectors to financial conditions. Durable good consumption just plunged as well. You see minus 30% year-on-year change at the trough of the process, and of course, then loans to the private sector became change became negative in beginning of 2011, and they're still shrinking as we speak. And all of a sudden, because with the sovereign debt crisis, investors start discriminating risk across EMU, then all of a sudden Portugal became a pariah on its own monetary homeland. And you can see the divergence here in terms of interest rates. This is the gray line is the interest rate on new loans to non-financial corporations in the euro area, and then we have the same interest rate, but for Portugal. And not only prices were much higher and diverging with Europe, but also volumes were not available at the first when the crisis struck. Of course, the ECB policy has done a lot to soothe the impact in terms of supply of funds to the real economy, but nevertheless, these loans are still contracting, and the convergence of interest rates towards the European average is still going very slowly. Now, eventually the economy stopped going south, and in a way it's very interesting that because Portugal was in a monetary union, it's very interesting that it could basically start its recovery with exports. And there was a lot of critics internationally and also domestically, Portuguese economists saying that the only way out for Portugal was to get out of the euro because we needed nominal exchange rate flexibility to basically boost exports and then kickstart the recovery. Well, it turned out that that was not needed. And you can see this is the exports as a percent of GDP. It has basically gone up more than 10 percentage points in a matter of 2.5 years. Okay, so in 2.5 years, Portuguese exports as a percent of GDP went up by more than 10 percentage points. Okay, and of course GDP contracted, so the denominator shrunk. But if you look at the nominal exports, you can see that there's a clearly upward trend line. So the crisis was a big game changer for the Portuguese economy. There are, of course, microeconomic reasons that explain that. Basically, a lot of firms that supplied the domestic local market shift to Spain, which was like, in some cases, a few kilometers away. Some other firms look at overseas markets like Angola or Brazil or even China or the US. And so there was this change in the mindset of Portuguese managers, and that they realized that Portugal was too little. There's more Portuguese in Paris than there are in Oporto, which is the second city in Portugal. So they suddenly realized that there's a world outside. But there are also some macroeconomic features that helped for this outcome, including the decrease in relative unit labor costs that was also a consequence of some structural reforms that were implemented during the adjustment program that lasted from 2011 to 2014. Now that's why Portugal was a textbook balance of payment crisis, going in the sense that all balance of payment crises are the end of the process of real appreciation. Okay, but basically the way out, the recovery from this balance of payment crisis is normally real depreciation that is promoted by normally huge or significant nominal exchange rate depreciations. That didn't happen in Portugal. Actually, the euro exchange rate fluctuated quite wildly during these adjustment periods. But what we can see is that here we have the differential between the Portugal nominal effective exchange rate and Portugal real effective exchange rate. You can clearly see here the loss of competitiveness that this internal appreciation basically produced, and then the mythical internal devaluation that a lot of economists thought it was impossible, but in fact Portugal did it, and Greece as well, for that matter. Okay, so this is the myth busting in the sense that we now know that internal devaluation is a perfectly normal process by which regions or countries that are tied within a monetary union can recover from external imbalances. Well, this is a side point. Austerity can be fair in the sense that you can pick the austerity measures so that you basically safeguard people with lowest incomes, and then you charge more on the highest income earners. And there's another interesting issue about structural reform in Portugal, which mainly hinged on labor market reform, basically labor market flexibilization. And Professor Weber was this morning referring that reform is painful. That's why it's not taken as usual. I don't know whether reform is painful because, especially in Europe, reform is only taken when things are very bad. So you have an endogeneity problem here. What we saw in Portugal was that labor markets and labor market specialists confirmed this, or at least don't deny. What we saw in Portugal was that once these structural reforms were enacted in the labor market in Portugal, there was this immediate payoff in terms of employment growth and unemployment decline. And here we have, this relation between real GDP growth and unemployment rates on an inverted scale. So it's kind of Okun's law. And what we can see is that never have unemployment decreased so fast for such a low level of growth. Okay, so there's tentative signs that, in fact, structural reform pays off quite quickly and in a way that helps diminish the suffering, especially of the people that are most hurt in economic recessions, which are, of course, the ones that get unemployed. Okay, so from basket case to poster boy in the sense that financial consolidation, both on the public sector and on the banking sector, proceeded at a very brisk pace. We can see here we have in dark pink Portugal primary balances and the euro area primary balances. And from basket case here where primary balance was in very high negative numbers. Now Portugal has had last year a primary surplus of 2%. There's not many developed countries that can brag about such kind of figures, and is much higher than what euro areas achieved. Of course, the weight of debt of interest, the interest burden is very high in Portugal, and so that makes these very nice primary surplus into a significant total fiscal. Fiscal balance. Deficits. Okay, there was this effort to rebuild the capital base of the Portuguese banking system, and again that was done quite recently, and at a time when there was a lot of at the time where capital was very scarce. I mean, there was not that many investors anxious to pour capital into Portuguese banks, but nevertheless that was done. And nowadays capital levels in Portuguese banking system are slightly below the euro area banking systems. But again, once these restrictions or once sentiment about banking improve, which is a big if, I guess the Portuguese banks will be able to raise more capital at more interesting prices and then close the gap with the European counterparts. Now, so basically, we're talking about a very limited period of time in which a lot of reforms were done, and the recovery, and basically from a deep recession, the Portuguese economy went to recovery mode. Of course, that was helped by a lot, or at least the effect of structural reforms, the effect of fiscal and financial consolidation were amplified by a very generous ECB policy. And here we have basically the percentage. This is estimated with our own numbers and also with some numbers that Nomura Securities published or research published. And basically this is the percentage of the total outstanding that the ECB is going to buy, okay, till the end of the program. And what we see after after the March meeting, which basically the ECB is going to buy 30% of the outstanding. I mean, the total cumulative purchases by the ECB until the end of the program in March 2017 will amount to 30% of the current outstanding public debt in form of bonds. Okay, so that's a lot. Okay, basically the ECB will take away from the market 30% of the supply of Portuguese sovereign bonds, and the reason why this is much more than it is for other countries, because the Portugal Treasury was shut out of the market during the most difficult year, so we could not issue bonds in capital markets. So for those years, that funding was basically provided by the IMF and the European Commission through the financial assistance package. This, of course, had a big impact in terms of yields. Here we have the yields of Portuguese sovereign debt, but you can see that it was also helpful, as Manuel mentioned, to the Spanish bond yields. And so again, this is good because it brought the funding costs of the Portuguese sovereign down, and also of the Portuguese corporates. It's a problem when the ECB decides to remove this accommodation. It might be tricky to see whether bond yields are going to increase a lot or not. Now, finally, we know that austerity is a hard sell politically, and even though the government that implemented all these structural reforms and did the austerity won the elections, but it didn't get an outright majority, so the left joined forces and basically elected a left-leaning a left-leaning government. And that generated uncertainty about the future of economic policy. And you can see there was, around the turn of the year, and you can see the pressure mounting in terms of the yields, which I just zoomed in, the Portuguese debts yields. So there was this uncertainty and also a bit of volatility in the banking system, Portuguese banking system. But then markets reacted immediately and sent sovereign bond yields up. Also, there was this reversal of some partial reversal of structural reforms, and you can see that investment is now contracting after expanding by more than 4% for more than almost 2 years, and now it's contracting. This is the gross fixed capital formation. It's contracting on a quarter basis. GDP growth on a quarter-by-quarter basis is slowing down very significantly, and employment is stagnant. So the idea, the lesson here is that there's no scope for complacency. There's still a lot of problems, structural problems in the Portuguese economy. There's still a lot of debt. So there's only one way to boost the recovery, and it's by keeping reforming. And I guess those are the lessons that we can take away from the Portuguese experience for the last 15 years. Of course, I am a bit worried about the course of economic policy in Portugal, but fortunately we have these, I'm sure that markets in peer pressure will make sure that the economic policy doesn't go astray, and so hopefully we'll have learned the right lessons from this bust without a bomb. Thank you for your attention.
And now we have the ultimate in flexibility. Gregorio decides on just-in-time showing up. So he got here, and he's our next speaker. So thank you very much for at least making it.
Thank you, John. Thank you, John, for inviting me here at the Banque de France. Thank you, everybody, to be here. I think that in assessing the ECB package, which was announced 10 days ago, many people disregarded the fact that it was triggered by a deterioration of the economic cycle and essentially by a significant downwards of the revision of the staff projections. So I like to focus first of all on the economic scenario, and later on the likely effects that the package can have on the European banking system, especially on the Italian banking system. So the first point is that economic growth in the Eurozone remains modest, around 1.5%, the same we had last year. In this chart, we have a breakdown of the different factors contributing to GDP growth last year, this year, and next year. As you can see, the colored green, orange, and so on, the colored portions of the bars are prevailing, even if decreasing. What are the colors parts? There are some factors which are exogenous to the system. So the first is the oil price collapse, which had and has a relevant role in supporting growth, is the orange part of the bars, and it meant 1.5% on a cumulated basis in 3 years. Second, the effect of the euro depreciation. The effect is vanishing because the euro depreciation probably is over, but it was quite significant last year and essentially last year. The third factor is monetary policy, which implies QE1 plus QE2, and now we can call it QE3, which implies 2 trillion euros of a monetary base injected into the system, its impact on growth, according to ECB estimates, can be above 1%. So the bottom line is that the white part of the bars, which can be considered the endogenous growth, is improving, but is still quite modest. The picture coming from a business service on one hand and from economic activity on the other hand is quite mixed. So we foresee that the international scenario and a lot of uncertainties will prevent an acceleration of the Eurozone growth this year. Weaker exports weigh on the outlook. And it's unlikely that the lower exports towards oil-producing countries and China, we talked about China this morning with regard to the change in the economic model, it's unlikely that this reduction in exports can be fully offset by demand from advanced economies. So as a matter of fact, and this is a new story for the Eurozone, as a matter of fact, net exports contribution to GDP is likely to be nil or even negative in 2016. Oil and employment will support consumer spending. Our outlook foresees a level of oil price which is 10 to 15% lower than last December, and this implies a similar boost in terms of disposable income, similar to what we saw in 2015. So on average, 0.6% of disposable income more. So growth has to rely in the Eurozone on domestic demand and in particular on consumption. I have a lot of uncertainty about investment forecasts because we see that many corporates are affected by the international uncertainty and by the fact that the capacity utilization is not very high. So they are putting off their investment expansion. As far as the inflation is expected to stay close to zero for most of 2016, and we foresee inflation to average 0.2%, only 0.2% this year, after zero last year. It's clear that the core inflation depends on the strength of economic recovery. And so I wonder if we need some unconventional measures, not only for monetary policy, but also from the fiscal point of view. I mean, deficit spending managed at the European level and not by the single countries. We have only a limited flexibility in terms of fiscal policy, but the contribution to GDP growth can be quite modest. The ECB and its effects on the banking system. I think we don't need to repeat once again what kind of measures we had. We have two sets of measures. Easy measures, we know that, and credit measures. Credit measures have the aim to provide funding certainty in order to stimulate loans, credit to the economy. But the key issue is that whether the package will impact on the Eurozone banking system and in particular on Italian banks. Probably the most obvious and intuitive effect of TLTRO II will be a decline of banks' wholesale funding costs. And this can be much higher for those banks which currently are paying more than others, because these banks can have funding in the worst case at a level equal to 0, and in the best case they can be paid 0.40 basis points. As far as Italy, we calculate that the TLTRO II will allow Italian banks to borrow up to some 260 billion euros. Just to have an idea, with the previous TLTRO I, Italian banks borrowed 113 billion euros, so can be much more important. To have an idea of the savings, let's consider that the yield to maturity of senior Italian banks, senior Italian bank bonds with expiring in 4 years, in 2020, nowadays is around 0.90%. This is for the sounder issuers. But the yields is several percentage points higher for the less solid bank. The other side of the coin are negative interest rates, which are part of the easing measures. Negative interest rates have a negative effect on banks' profitability, as they tend to erode net interests. We have money market rates in negative territory, and we have downward pressure on lending rates. So here, talking about the negative rates, the key point is that if we have to ask our customers to pay in order to have deposits with the banks. But as there is an asset, which is cash, cash is the only asset that can't have negative rates. So I think it's quite unlikely that we can directly ask customers to pay to have a deposit. So the pressure on the profitability can be strong, but fortunately, even today, the governor of the Banque de France reassured about that this current level of negative rates is enough, and we hope that it will be confirmed also by the board of the ECB. The unfavorable impact of negative rates can be, at least temporarily, be offset by capital gains on government bond holdings. And if we don't take into consideration the risk that we can have a new capital requirement on the bond portfolio, which is under discussion according to Basel III works, this effect, the capital gains, can be more relevant for Italian banks compared to peers because they have much more bonds than other banking systems, 11% as a share of total assets compared to an average of 4% in the Eurozone. The cost for banks of unconventional measures could also be reduced if these measures produce a steepening in the yield curve. But the US case, for example, shows that the yield curve began to steepen only when the evidence of a recovery started. This is still not the case for the Eurozone. The graph, the chart on the left, as a consequence, we do not expect a positive impact on banks' profitability from this channel, at least for now. Finally, a negative consequence of the easing measures will be an increase in the cost of maintaining excess reserves. This cost is much more relevant for Dutch and German banks, which have the largest amount of excess reserves. Just to give an example, German banks hold 175 billion euro, more or less 40% of the total amount of excess reserves. The impact on Italian banks should be quite limited because they have only 5.5 billion euros. These slides brings us to the core issue. Will cheaper banks' funding costs succeed in stimulating credit and economic recovery? And the answer is quite uncertain. I'm quite skeptical on that because the risk of the borrowers doesn't change for the TLTRO. We can have a higher propensity of banks in lending money, but probably we are not going to see a relevant change from this point of view. On top of this, note that a sort of crowding out can emerge as a result of the opening of the purchasing program to corporate bonds. Because if corporate bonds are bought by the ECB, non-financial institutions are stimulated in offering that. So let's come to a conclusion. The ECB package will guarantee additional liquidity to the banking system, but the final impact on lending flows and ultimately on economic growth is quite controversial. Also, the effect on profitability is not easy to assess. The package will impact the bank's balance sheets both positively, I'm referring to capital gain on government bonds, for example, but also negatively with the compression in interest rate margin. All in all, the cumulated effect can be estimated equal to some hundreds of million euros as far as the Italian banks and around 3 billion euros for the European banking system as a whole. We are time constrained, so I'm stopping here, and if there are some questions regarding the Italian banking system, I'll be more than happy to answer. Thank you.
Jill, do we have time for questions? 15 minutes for questions. Okay, good. So first one, I have to ask, Manuel, why did Spain pass reform? We've heard so much discussion this morning about the need for reform. I want to know, what is it that got Spain to reform?
Yeah, I didn't mention enough. Yeah, Spain passed a very strong reform, I think, and we were lucky in the sense that we passed it when we passed it, and the fact that some of it would have to be passed eventually, right, like the banking reform. So particularly was labor market reform, which has worked like the same thing as in Portugal, being very efficient. Nobody expected unemployment to come down the way it has, right? And the banking reform has actually given you, now Spanish banks are in a much better position than they were a few years back, and they're in better position than other banks around. Why did they pass reform? I think the straight answer is we have no choice. Literally, I think the difference between now and then, remember, this is 2012, right? The ECB was not as willing to buy time for countries as it is right now. The monetary policy was not as easy right, and so on. So in that extent, the pressure exerted on markets by the spread, right, the fact that the Spanish was under the microscope to the extent that first it was close to some countries, it was the next one down the line, right? It was Greece, then Portugal, the next one, and the big guy down the line that was, the key was Spain. We had a weak, I wouldn't say weak because actually the banking sector was quite strong, but we had several important issues in the banking sector. We had which actually was shown before, we had a huge, pretty big bubble in the housing market, right, which everybody knew. I mean, Spain built 800,000 homes per year. Remember, that's more than the UK, France, and Germany combined, right? That's close to half of the US, right? Yeah, and this is only 35, 40 million people. So, I mean, that was a big bubble. So when you put all that together, it didn't matter whether you looked at the insights. Just looking at the picture, it was obvious that was not sustainable. The only way out, really, right? New government, which helps, right? You have a new government, which comes with the platform, will change anything from the past, reform. So we had no choice. There was a willingness. And when you look at something that's happened for Spain, for Europe, and it was mentioned before, but I would say in Spain, even much more so than in other countries, is that you don't move until you have to, but when you have to, you do it, and you do it efficiently, or you, yes, do whatever you need to. Then the problem is once the pressure is off, right, you don't reform much more. And that's what's happened to Spain and some other countries in the last 2 years, right? No pressure.
Thank you. Jose, and then I'll turn to Gregorio. Jose, it was interesting, the TL program that the ECB has put in place. I noticed you have this one graph where you're basically saying the loans to the private sector are actually declining. They're not growing at all. So if you do that, if the ECB goes through with another program, number 2, how much difference is it going to make if there's not a lot of lending? And then Gregorio, the same question, I thought.
Basically not much, because there's no demand, at least at the levels of risk that banks want to take. So I guess for the, Gregorio showed a graph which was the exposure of the Portuguese banking system to its own sovereign debt, and you saw that is about 6%, which is significantly above the EMU's average. So I guess that's the main benefit for the Portuguese banking system, will be appreciation, if that happens, of course. And of course, the appreciation of Portuguese sovereign bonds depend on the economic policy remaining prudent and compliant with European rules, which when you have the Communist Party on board, supporting the, in the coalition that supports the government, you never know, but fingers crossed.
Yes, I share his point of view. I think that the main impact of the TLTRO2 is on the cost of funding, which becomes cheaper for Italian banks and for the banks of peripheral countries. As far as the lending trend, it's hard to see substantial changes. Also because, you see, the fact that the ECB has two different aims. On one hand, monetary policy, and on the other one, the supervisory activity. So it looks a little bit schizophrenic in the sense that we have a huge injection of liquidity, so it's extremely expansionary. But on the other hand, more and more capital requirement, more stricter regulation, and so on. So that is an absorption of liquidity. So it looks like the famous joke of Mrs. Thatcher when she asked for an economist with only one hand.
Any questions from the audience? Any? Sir, go ahead. Okay. Catherine? Go ahead. What do you got, kid?
It's to the Iberian economists here. Uh, yeah, economists, Siberian. My question is, do you guys think that if the ECB hadn't intervened, you would have had more pressure on countries to reform, or maybe those countries would by now be out of the Eurozone, meaning that it was reform fatigue and not moral hazard that made them stop reforming?
In the case of Portugal, I don't think you can tell apart you can distinguish between reform fatigue and moral hazard, because governments will only enact structural reform if they don't have any other choice, or if they are pushed. So once like the Troika, as we call it in Portugal, was happy with the reforms, happy with the consolidation that was done in the public sector and financial sector, then moral hazard struck again, and then politicians just relaxed and partially reversed. So I guess that the ECB, that's what Professor Weber was telling about this morning. It's not actually a breach, because if the ECB it's on, then reforms are off, and and conversely.
I would go a little beyond that. I would say that moral hazard is always the case, right? When somebody intervenes to make things easy, there is always some type of moral hazard. The question is, you cannot risk. At that moment, you couldn't risk the alternative. Therefore, you didn't care as much about moral hazard as something to be dealt with down the line. Would you have more reform without help by the ECB? Probably, but I don't think the alternative was exiting the euro. Yeah, you could have had more, but what is the ECB's role? It's like asking something very strange. It's something like, whenever we talk about, in Spain, the case, for example, the fact that this money was helped to rescue the Spanish banking sector, right? I always say, I don't know whether they were rescuing the Spanish banking sector or the German banking sector. To extend that, actually, I don't know who would lose. Obviously, you who are, build all the houses, you have a problem. But the guy who loaned you the money, it's like when you owe the bank $100, you got a problem. When you owe the bank $1 trillion, he's got a problem, right? And the bank was Germany. So to the extent that Germany was helping these countries in the periphery, namely Spain or Portugal, they were actually helping themselves. Let's not kid ourselves. I mean, in Europe, we all are friends, we all work together, but we're still domestic. I said, domestic policy dominates European policy. So to that extent, yeah, maybe we would have had more reform, and that's why I said that Spain had reform because they had to. They didn't have the help. With the ECB helping at the time, probably they would have done less. But I'm glad they didn't. We needed the reform. I think all Europeans, I think Catherine mentioned this morning, I think all European countries need to more flexible markets, goods, products, and whatever. So,
You had one question, sir, and then I'll finish up with non-performing loans for Gregorio.
Yes, David Marsh, another Iberian question for Jose Maria. You mentioned the international investment position of Portugal. I think your figures only went up to 2010 or 2011. I would imagine that the net debt has gone up further despite your very impressive efforts to get the current account in order. Can you give us an idea of how that is progressing? And also it goes back to what Axel Weber was talking about, this amazing build-up of the debts and the credits within the euro area. How do you see that debt being eradicated over time? Will we get growth, or will there have to be some massive debt restructuring involving the creditors writing off part of their balances?
I don't know under which house rules I would be able to fully reply to you, but the thing is, I guess that 130% of GDP of public debt isn't sustainable. I mean, you have to produce kind of a primary surplus of about 4% and still have 2.5%, or sorry, 3.5% nominal GDP growth every year for forever. That's not going to happen. So somewhere along the way there has to be some kind of restructuring, which well, a lot of has been done already, because the interest rate is very low, the maturities have been hugely extended, so some sort of restructuring has been done, and probably some more will have to be done. Regarding the international investment position, I guess it stabilized in 2015, but it continued to worsen despite the current account surpluses, mainly because of FX effects, foreign exchange effects.
So last question, Catherine?
So should the ECB be pushing much harder for banking union on the grounds that that is a strategy that will at least allow consolidation of the banks? So it's banking union plus some treatment of asset managers. So you can consolidate the banks, throw the NPLs off to asset managers at some price. You need to deal with the tax treatment of the loss. But why shouldn't they be pushing much harder on banking union, or should they be? I think that they should, obviously, but tell me if I'm wrong.
Go ahead, Manuel.
I'll go first because I'm not the banker, so I can afford to say whatever. I said you're completely right. For me, the first question, if you want to go back, and since I'm substituting a banker for Spain, but is why didn't the ECB, the European Commission, did not force banking? I would go farther, not banking union, banking integration, right, in Europe. Why, when we reformed the Spanish banking sector, didn't we force more international, transnational access to foreign banks to the Spanish market? It's funny that European banks have expanded everywhere, Latin America, the East, whatever, but we haven't expanded within Europe. I mean, there is no, the Spanish banks, except the UK, which is kind of funny, the only guys who are thinking of exiting, right, of the European Union. It's like Spanish banks are in the UK, whatever, they're not in France, Germany, or Italy. Same thing with almost everybody. It doesn't make any sense. So I agree with you. Why haven't they done it?
So you're looking forward to the stagecoach running across most of Europe? Well, thank you very much, panel, and we'll move on to the next session. Thank you.